Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the ETF.com conference. I'm with the president of ETF.com, Matt Hougan. Matt, congratulations, record turnout. This is great.
Thank you, Tom. We're pretty excited about it. We have over 1,900 people registered today. That's up from 1,500 last year. It shows you the growth in ETFs, the difference they're making for advisors, and I think it's just going to keep growing from here.
Well, it's just great celebration of the industry. Speaking of that, this morning, you folks had a lot to share about really the wave of where this whole industry is going.
That's absolutely. We tried to scare people a little bit in our keynote, get them thinking about their business. Here's what we said. We said the investment world is now flat. ETFs have made it so that you and I can invest in the same products at the same prices as institutions. That's fantastic, but it creates a wave of challenges. We've also seen recently investment advisory fees being flattened. We have Wealthfront coming to market with a great portfolio that they price at 25 basis points. What does that mean to an advisor who's charging 1%? That's what we wanted people to start thinking about today.
It's disruptive. So these robo-advisors that you talk about, do you think they're really going to shake up the financial advisor industry?
I really do. Think about the service they're offering. You get a well-diversified portfolio customized to your risk tolerance, managed by Burton Malkiel at Wealthfront, that's tax loss harvested, rebalanced, and they charge you 25 basis points. If that's the value of asset allocation, you have to build other services around your business if you want to maintain that 1% margin. I think it's a big deal.
So the average advisor out there is going to say, yeah, but Matt, next big market correction, when you as a client to one of these big robos, who do I talk to? I need someone to hold my hand. Isn't that worth the extra 75 basis points?
That is absolutely, I agree, that's absolutely the opportunity they have. That is where advisors can add their value, but they need to realize that, be ready for it, and to be ready to provide that behavioral coaching that's the foundation of the value they're giving to clients. It's no longer building a great portfolio, it's knowing your client and working with their specific needs and coaching them through that next market correction.
So Debbie Furr was on earlier and she told us that the ETF assets globally are only $60 million shy of all assets in hedge funds. Is that crazy?
It's not crazy, it's fantastic. We should be having a party, right?
Yeah.
That's good news for investors. Instead of 2 and 20, it's 20 basis points or less, and that's just great news.
So what's the next big wave this year? We saw S&P 500, bonds, long, and you really couldn't mess up. Are there going to become some key opportunities in certain areas?
And key challenges. I think there are two things that advisors should have top of mind. One, you and I have talked a lot about before, currency hedging. Yeah. People are calling for the euro to go back to parity. That's going to be painful for your international investments if you don't currency hedge. Fortunately, you can now with ETFs like HEDG and the DB ETFs. The other thing, what do you do when rates finally start to rise? I know we thought they would rise last year, they didn't, but at some point they're going to start to trickle up. How do you handle your bond portfolio? I think those are the two questions every advisor should be asking themselves.
Well, is liquidity there in the fixed income area, number one, and number two, are there enough strategic ETFs to be able to tackle those challenges?
I think it's a great question. Liquidity is there in most of the ETFs. High yield bonds, regular bonds, you can get there. There are concerns in areas like bank loans. If that market falls apart, could we see dislocations in ETFs there? I think people are worried about it, but you can trade HYG at penny spreads all day long. On the tactical side, I think that's a big question. When we end a bull market, we get into a more mixed market. You want to get more tactical with your bond exposure. You and I know that Jeff Gundlach is coming out with an ETF. Maybe you outsource your management to Jeff and say, you handling the interest rate curve. I think that's going to be a big question. I think you're going to see a lot of advisors do that.
So advisors that maybe have embraced these core, ETFs, low cost basis, great, but now, rather than go with active managed mutual funds, they're really turning to maybe strategic or alternative-based strategies?
I think they're thinking about it. It's been shooting fish in a barrel for the last 30 years on bonds, and now those fish are in a fast-moving stream. So yes, no active management. You can't pay 1% when bond return expectations are lower. You need to lower those fees, but still get the high-quality management you want, and maybe stuff like Jeff Gundlach's ETF is going to offer that.
Great ideas. Matt, thanks so much, and thanks for allowing us to be here. We really enjoyed it.
Thank you, Tom. We're glad to have you here.